A significant financial realignment is underway, one that operates largely away from the public spotlight, but carries profound implications for global markets. We are witnessing the movement of trillions of dollars and a fundamental shift in strategy from the world's two largest economic powers, a recalibration with the potential to redefine international finance. This is far from a minor trade disagreement. It is a direct clash of financial sovereignty, where each decision carries substantial weight for the global economic order. At this moment, major American financial institutions are actively pulling capital from China at a rate that indicates more than mere prudence. It signifies a strategic retreat. In response, Beijing is executing an equally consequential countermove, a large-scale reduction of its holdings of United States Treasury debt. This is an action with the capacity to reshape the very foundations of the global bond market. Do not mistake this for a routine policy adjustment. It is a deliberate message, a clear warning, and potentially the opening move of a far broader long-term strategy. Our analysis tonight will detail the driving forces behind the American banking withdrawal from China, the geopolitical pressures, the internal financial risks, and the regulatory demands compelling this shift. Furthermore, we will examine why China's divestment of over $1 trillion in US debt is not merely a retaliatory measure, but a calculated strategic play, fraught with both risk and opportunity. We will break down how this bilateral financial confrontation reverberates through global markets, affects national currencies, and ultimately influences the cost of borrowing for governments and citizens alike. The impacts on interest rates, inflation, trade flows, and the delicate balance of power between these two economies will be made clear. Crucially, our report will uncover the lesser-known factors propelling China's move away from dollar dominance and why a growing number of analysts perceive this as the early stages of a systemic transformation in international finance. The full picture, however, requires a deeper investigation. The most critical details often lie beneath the headlines, in long-term strategic agendas, structural economic vulnerabilities, and the quiet signals from institutional investors. Understanding these undercurrents is essential to grasping the new reality of the global economy. Now, to the substance of this withdrawal. Major US banks and financial institutions are decisively reducing their exposure to China, and the pace of this disengagement has accelerated beyond earlier projections. This is not simply an accounting exercise. It reflects a fundamental and growing uncertainty regarding the Chinese market. The business environment has demonstrably changed. A region once viewed as a guaranteed engine for growth is now approached with marked caution. A primary catalyst is escalating geopolitical tension. The strained relations between Washington and Beijing have layered significant risk onto foreign investment. Policy volatility, the potential for sudden regulatory tightening, and the persistent threat of new tariffs or sanctions have rendered long-term planning increasingly difficult. For fiduciaries tasked with protecting client capital, such uncertainty is a definitive warning signal. Compounding this are internal financial risks in China, notably slower economic growth, instability in the property sector, and stricter capital controls. As predictability erodes, large institutions inevitably move to defend their positions. For US banks, this translates to reduced investment, scaled-back operations, and a reallocation of capital towards jurisdictions perceived as offering greater stability. Added to this is intensified regulatory pressure from Washington itself. Increased scrutiny on American operations within China, particularly in sensitive sectors, has created a more complex and costly compliance environment. Consequently, many institutions are rationally choosing to shift capital to regions with clearer oversight and lower political risk. This collective pullback signals something more profound than a cyclical adjustment. It indicates an erosion of confidence in the stability of China's financial system. When institutions of this scale withdraw, global investors take note. It suggests a rising risk of unforeseen shocks, whether from debt concerns, transparency issues, or state intervention. The message is unequivocal. The operating environment is no longer as predictable as it once was. This capital flight underscores a broader reprioritization within global finance. Institutions that were heavily reliant on Chinese growth are now actively diversifying. Capital is being redirected to Southeast Asia, India, Europe, and back into the United States as the pursuit of safer, more balanced portfolios takes precedence. This trend develops gradually, but it possesses a powerful momentum. As more institutions scale back their commitments, each withdrawal further strains the financial relationship between the US and China, adding tension to an already fragile economic connection. The effects are not contained. They ripple outward across global markets. This shift demonstrates that both powers are preparing for a new and decidedly more cautious phase in their economic engagement, one defined less by cooperation and increasingly by strategic competition. What we are seeing is a calculated financial maneuver, often termed a treasury dump. This is the deliberate process by which China and its state-linked institutions are reducing their substantial holdings of United States government debt, securities that effectively represent loans to the American government, traded for interest and perceived stability. For years, China stood as one of Washington's principal foreign creditors. That position is now being systematically unwound. Its holdings have entered a steady and significant decline, reaching levels that have not been observed for years. This is not a subtle shift happening in the background. It is a conspicuous month-on-month reduction that financial analysts globally are tracking with acute attention. The total portfolio has fallen well below its historical peaks, marking a slow but unmistakable strategic pivot away from assets denominated in US dollars. When a creditor of this magnitude divests, it transcends mere portfolio management. It is a statement of strategic intent. Several core motivations underpin this move. Primarily, it is a drive to diversify China's foreign exchange reserves. Concentrating vast wealth in a single asset class, particularly one issued by a geopolitical rival, represents a significant vulnerability. By scaling back US Treasuries, Beijing can redistribute its reserves into other currencies, sovereign bonds, and tangible assets like gold. This aligns with a second, more profound objective: to diminish systemic reliance on the US dollar. The dollar's dominance grants the United States considerable financial and political leverage. China's drawdown is a direct effort to reconfigure its economic architecture for greater independence, a tactic that supports its long-term ambition to elevate its own currency, the yuan, on the international stage. There is a clear defensive rationale as well. In an era of heightened geopolitical friction, dollar-denominated assets pose a potential risk. By reducing its exposure, China creates a financial buffer, hedging against the possibility of future sanctions or restrictive measures. Furthermore, this action serves as a potent form of geopolitical leverage. The large-scale selling of U.S. debt sends an unambiguous signal to Washington. It demonstrates Beijing's capacity to exert influence over the American bond market, a market where interest rates and borrowing costs are set. The goal may not be to trigger instability, but the mere possession of this capability becomes a powerful card to play during negotiations. Domestic economic pressures also contribute. Faced with slower growth and currency management challenges, reducing treasury holdings frees capital. This liquidity can be redirected to support internal financial objectives and stabilize the yuan, granting policymakers greater flexibility. While other nations are making similar adjustments, China's actions carry disproportionate weight due to the sheer volume involved. Each sale is a step toward reshaping the old financial order, and the world is watching the destination closely. The global ramifications are immediate and significant. Large-scale selling exerts downward pressure on treasury prices. As prices fall, the yield or return demanded by investors necessarily rises. This is critical because US Treasury yields are the bedrock of global finance, underpinning everything from international mortgage rates to sovereign borrowing costs. When these yields climb, the pressure reverberates throughout the system. For the United States government, it means servicing its substantial debt becomes markedly more expensive, potentially pushing interest payments to unprecedented levels. For the American public, it translates into higher costs for mortgages, loans, and credit, For businesses, increased financing expenses can stifle investment and curb hiring plans. Ultimately, an economy burdened by more expensive debt becomes far more susceptible to any subsequent financial shock. This is the real-world consequence of a strategic financial decoupling.
The consequences of this financial rebalancing extend far beyond the immediate mechanics of the bond market. Rising US Treasury yields initiate a global recalibration of investment portfolios. Capital is reallocated on a massive scale, flowing away from perceived risk toward greater stability. Should yields climb too sharply, the resulting shock to confidence can trigger significant volatility across equity and corporate bond markets, precipitating sharp corrections, particularly in vulnerable sectors. Currency markets are equally responsive. While a spike in yields may temporarily bolster the US dollar as investors seek return, a sustained decline in foreign demand for American debt ultimately threatens the currency's long-term strength. This instability produces volatile exchange rates, directly impacting trade costs, import prices, and inflationary pressures worldwide, a phenomenon felt most acutely by nations deeply entrenched in the dollar system. As confidence in traditional dollar assets evolves, capital seeks new harbors. Gold typically gains status as a primary safe haven asset. Investment flows increase toward other sovereign bonds, such as those of Europe and Japan, while alternative destinations like select emerging markets, commodities, and digital assets attract funds as part of a broader diversification drive. This global repositioning of capital redefines financial conditions across multiple economies simultaneously. Nations with strong fundamentals may see benefits from increased demand, while more fragile economies face destabilizing outflows and heightened stress. The ripple effects influence domestic interest rates, equity valuations, and central bank policies on nearly every continent. The impact, therefore, transcends a bilateral dispute. It recalibrates global liquidity, alters investor psychology, and forces a reassessment of long-term strategic planning for governments and institutions everywhere. To interpret China's actions merely as retaliation for US banking withdrawals is to misunderstand a deeper, more calculated agenda. What we are observing is the deliberate execution of a long-term strategy crafted over years to fundamentally rewire China's financial architecture. The objective is clear: to systematically reduce dependency on dollar-dominated assets and thereby insulate the economy from external coercion. A central pillar of this strategy is the comprehensive rebalancing of China's foreign exchange reserves. For decades, these reserves were heavily anchored in US Treasury bonds, a source of security, but also a tether linking China's financial stability to American economic policy. Recognizing the risks inherent in this dependency, especially amid escalating tensions, Beijing is now severing that tether to reclaim sovereign control over its financial future. Diversification is the operational method. This is evidenced by a deliberate accumulation of gold, a timeless, non-aligned store of value. Concurrently, China is redirecting capital into European bonds, emerging market assets, and strategic infrastructure investments. This spreads risk and mitigates exposure to any single economy's downturn. Crucially, this is paired with a concerted push to internationalize the yuan, promoting its use in trade and building holdings of yuan-denominated bonds. The goal is to offer a viable alternative to the dollar system, enhancing China's global influence and fostering regional financial networks. Further motivating this shift is a calculated assessment of American economic volatility. From soaring public debt to political brinksmanship over the debt ceiling and abrupt shifts in monetary policy, the United States presents a profile of growing uncertainty. Beijing views these not as cyclical issues, but as structural vulnerabilities, prompting a defensive reallocation of reserves to guard against future shocks. Ultimately, this is a strategy forged in the furnace of geopolitical competition. Financial sovereignty has become a front line in strategic rivalry. By reducing its dollar exposure, China diminishes its potential vulnerability to sanctions or financial blockades in any future confrontation, preserving its autonomy to act on the global stage. This is not a reactive tactic, but a proactive doctrine, a blend of economic foresight, long-term planning, and a determined quest for resilience. Step by deliberate step, China is constructing a financial system whose stability is not held in Washington and whose commanders can navigate an uncertain world with greater independence and control. This strategic pivot by China, however, is not without considerable risk. While the US Treasury market is vast, a large and rapid sell-down by a major holder can still generate significant turbulence. A substantial liquidation would drive prices down and yields up, potentially creating instability across the global financial architecture. As analysts warn, overly aggressive selling could precipitate periods of intense market volatility, with repercussions far beyond the bond market. Even a modest shift in posture from a creditor of China's scale can alter investor psychology and provoke wider instability. For Beijing itself, the execution of the strategy is fraught with operational difficulty. Divesting such a monumental portfolio in one of the world's most liquid markets is a complex undertaking, involving substantial transaction costs, precise timing, and the risk of incurring losses, especially if other major holders sell concurrently, depressing prices and devaluing China's remaining holdings. The process demands meticulous coordination. A misstep could mean realizing unnecessary financial damage. Furthermore, identifying sufficient alternative assets that offer comparable liquidity and stability presents a profound challenge in its own right. The strategy also introduces significant domestic currency risk. As China reduces its dollar holdings, it may need to deploy its reserves to support the yuan, placing pressure on its domestic financial system, particularly during periods of economic softening. A rapid depreciation of the yuan could itself trigger investor alarm, prompting capital flight and compounding stress within China's own markets. The potential for global spillover effects is even more unpredictable. Financial markets react swiftly to uncertainty, and a major recalibration of treasury demand could ignite sharp movements in currencies and equities worldwide. The result could be capital flight from vulnerable economies, violent exchange rate swings, and heightened borrowing costs for nations reliant on dollar financing, squeezing national budgets and amplifying financial fragility. There is also the critical risk of market misperception. Large-scale divestment can be misinterpreted as a signal of underlying distress or a lack of confidence. This perception alone, irrespective of China's strategic intent, has the power to trigger panic selling, abrupt asset repricing, and a broad erosion of market confidence, potentially forcing central banks into difficult interventions. These layered uncertainties mean China's path is a precarious one. In an interconnected global system, a strategic shift by a principal actor can provoke unplanned and cascading reactions. Every move must be precisely calibrated to avoid triggering shocks in an already sensitive environment. Looking ahead, as China continues to reshape its reserves, the next phase may catalyze a broader structural shift away from dollar hegemony. Many nations are already exploring ways to reduce their exposure to the dollar-centric system. China is actively fostering this trend, working to build a more multipolar financial architecture where currencies like the yuan play an expanded role in trade and investment. This is a long-term project. Through expanding currency swap agreements, promoting yuan-denominated trade, and developing alternative financial infrastructure across Asia, the Middle East, and Africa, China is slowly constructing the plumbing for a parallel system, one that offers reduced dependency on U.S. financial channels. This evolution presents a new set of challenges for all participants. Interest rate risk becomes more pronounced, and traditional safe portfolios require reassessment. Sovereign reserve managers globally are now compelled to reconsider their strategies, balancing classic assets against alternatives like gold, regional bonds, and emerging market currencies. This recalculation of risk may redefine global capital flows for years to come. At the national level, the drive for financial sovereignty is intensifying. The goal is to insulate economies from sanctions, political volatility, and sudden shifts in U.S. monetary policy. Central banks are diversifying reserves to bolster independence. These adjustments are not merely technical, they are forging new economic alliances and deepening partnerships based on a shared interest in a less centrally dominated financial world. The geopolitical dimension is now the primary arena in which the future of global finance will be decided. Economic statecraft, the use of financial tools as instruments of national strategy, has moved to the center of great power competition. As Washington and Beijing advance fundamentally different visions for the international order, control over financial architecture has become a lever of power as consequential as military might or diplomatic influence. Every transaction is now strategic. A reallocation of reserves, the negotiation of a bilateral trade pact, the structure of a currency agreement. Each is a move in a protracted contest for long-term strategic and economic advantage. This competition is creating space for other major actors, economic blocs, including the European Union, and rising powers such as India and the Gulf states are actively exploring methods to enhance the international role of their own currencies and financial institutions. Concurrently, the advent of digital currencies, particularly those issued by central banks, introduces a new variable, a source of both potential disruption and significant opportunity. The collective result is the gradual emergence of a more fragmented, yet potentially more resilient global financial ecosystem. We are moving towards a multi-node system where nations depend less on a single dominant currency and more on a network of interconnected alternatives. We are, in essence, entering an era of distributed financial power. Strategy is becoming more complex, and the geopolitical balance between major economies will increasingly dictate the rhythm of global markets. The withdrawal of American capital from China, met with Beijing's divestment from US debt, underscores that this is not merely a financial story. It is the manifestation of a profound political and economic realignment between two superpowers. What appear as technical adjustments are in fact signals of a systemic transformation with the power to redefine the mechanics of the entire global economy. The repercussions on interest rates, capital allocation, and currency stability will be felt far beyond the capitals of the competing powers, impacting the financial security of nations worldwide. We may well be approaching an inflection point. The balance of financial power is undergoing a historic recalibration. As both nations methodically execute their strategies, the consequences will cascade down to the level of households, businesses, and governments across the globe. Every decision in this strategic contest will define the future landscape of trade, the cost of borrowing, and the pathways for economic growth. In periods of such consequential change, vigilance is paramount. The world of high finance moves with decisive speed, and the policies enacted today will establish the opportunities and the risks for decades to come. It is essential to observe closely, to analyze critically, and to understand the forces reshaping our economic reality.